Gourinchas. I remember Pierre-Olivier from the time he was this tall. He was a first-year faculty member at Princeton when I was a first-year graduate student. So I learned so much from him, and I'm looking forward to learning more. And it's very clear that we all prefer listening to what he has to say rather than having his CV read to us again. So I'm going to skip that part and say it's a pleasure and an honor to have you here to deliver this talk. Thank you. The floor is yours.
Thank you, Refet. And I remember him when he was that tall. So it's really a pleasure to be here. So thank you very much for inviting me. And when Refet reached out, he also said, I said, well, what do you want me to talk about? And he basically said, oh, it would be wonderful if you talk about macroeconomic policy in emerging markets. So I will try to oblige and sing for my supper. So I will basically do 4 things. I will start with a brief summary of what we're seeing when we're looking at emerging markets right now, how they've been handling the reopening post-COVID, the energy crisis of the last few years, the surge in inflation, etc. So I will kind of take stock of some of the things we have here. And then I will discuss 3 key challenges for emerging markets. So not new challenges, many of them, but we're in particular place here. And so I'll talk about external sector volatility. I'll talk about financial stability, and something that is maybe a little bit more new is geoeconomic fragmentation, which is the fact that we are seeing a lot of centrifugal forces in the global economy. And that has already some impact, and then we can think about how it might impact emerging market economies. So let me start with this. So first, where we are, in a sense, the picture here is one where emerging markets have been really remarkably resilient in the last 3 years or so. Even when we look very recently, so the figure on the left is showing you Q3 growth surprises, so the realized Q3 growth versus the predicted Q3 growth in our October round of projection, and you have a bunch of countries. In red, you have emerging market economies, a bunch of emerging market economies that are doing better than expected, even very recently. Some very large ones, India, China, Indonesia, and etc. And when you do an exercise at a slightly longer perspective, so this is what you have on the right here, we are doing some work on trying to understand drivers of growth, and we're doing all kinds of growth decompositions for a large number of countries. And I'm showing you here the GDP levels relative to the October 2022 WIO, and you see that emerging market economies have been doing quite well, and a big part of that is coming from more of the supply side factors, and in particular labor force participation. That's the blue bars here. So there was a concern for many emerging and certainly low-income countries coming out of the pandemic that there would be very persistent scarring, that labor force participation, employment, the investment, the productivity, human capital, some of the key drivers would remain depressed for a while because many of these economies were hit very hard. They didn't have the same kind of fiscal buffers to protect their population as advanced economies did. And for a while we did see that, but now we're seeing some rebound, and we're seeing some catch up here. So that's also something that is interesting to observe. Now, another important development to keep in mind is that emerging market economies have, many of them were in on the game much earlier than advanced economies when it came to tightening monetary policy. And so you have here on the left, this is the number of increases and decreases in policy rates. In red, you have emerging, tightening countries. In green, these are easing countries, and the dark red are the EMs. And you see that, don't know if I have a pointer, but you see that, initially, when the advanced economies were not even yet tightening, the EMs were already tightening, so in mid-2021, end of 2021, and so they started really fighting this surge in inflation much earlier. And for many of them, they even started easing earlier. You see here the green. So some of them have inflation that is already coming back down much more decisively than in advanced economies. They've started cutting a number of Latin American economies. So emerging markets were really very, very reactive here to the inflation surge. And their inflation rates, which you see here for headline inflation, in deviation from central bank targets, in part the reason they were more responsive is there was a bigger surge initially, and they also had to do something that was more aggressive. But in a sense, they were very, very successful in bringing it down very quickly. So resilience in terms of the underlying, inputs to output, resilient and pretty aggressive policy stance that worked pretty well. So all of these are sort of good developments. Another thing that we see is when we look at the external side, and here I'm plotting the interest rate differential with the US. So this is US interest rate minus whatever group or country interest rate. So when it's negative, it's you have a higher interest rate than the US, a higher policy rate than the US. When it's positive, it means you have a lower interest rate. And what you see there is, of course, EMs tend to have policy rates that are higher than the US, so it always tends to be negative. But because they started hiking earlier, you see that before 2022 here, that differential was sort of moving in the right direction. That attracted capital flows, and that left a lot of these countries in positions where we haven't seen any sudden stop. Okay, we haven't seen any sudden stop in the EM space, despite 500 basis point increase in the policy rate in the US. Now, that's one of the things where if you had asked me at the end of 2021, the Fed is about to hike 500 basis points, the ECB is going to do the same thing, what do you think will happen in emerging markets? And I've said, well, based on historical experience, it will be a bloodbath. It will be very, very difficult. Capital will want to flow back. There will be massive depreciation of currencies, and it would be very, very hard for these countries to hold that tight. And that's not happened at all. That's the one crisis that we didn't have. Okay, and that's, I think that's important. What this thing on the right is showing you is that capital kept flowing into emerging market economies. Now, there was a lot of differentiation. That's something I'll come back to when I talk about geoeconomic fragmentation. We've seen outflows from China, a lot of outflows from China, pretty persistently through 2022 and 2023, but you had inflows in Latin America, you had inflows in Africa and the Middle East, you had inflows in other emerging Asian economies. So a lot of differentiation, no sudden stop, the market's still functioning. And when we look at exchange rates, one implication of these very sharp movements in policy rates is they account for quite a big deal of what we see when we look at dollar rates for many countries. So this is on the left here, this is looking at the change in the exchange rate vis-a-vis the US dollar. When we look at since 2022 up until January of 2024, so just a few days ago. And what you can see there is, for many of them, there was a fair amount of depreciation in 2022, but some of it has been reversed in 2023. And when we decomposed, we did an exercise with the VAR decomposition with different drivers of dollar exchange rate for a bunch of countries using macro news, terms of trade, monetary policy. What really came out very, very strongly is there is a fair amount of a movement in dollar exchange rate that seems to be driven by monetary policy, by US monetary policy. And so we have seen currency movements. A lot of these countries have let their currency adjust. They have not been trying to fix the peg. They've not been trying to hold to a particular value. They've let the exchange rate adjust. And that may also have contributed to the resilience. We don't see much in terms of global risk component contributing to this big exchange rate fluctuations we've had. And in part, this is because the markets, despite the big increase in policy rates, overall the markets have remained very optimistic about global conditions. And so financial conditions from the price metrics have not tightened very much. So one other thing that accounts for some of the resilience we see in emerging markets, there are two things here that we emphasize. One is, of course, this tightening in policy rate. This is in the context in which you have this surge in energy and commodity prices, right? Throughout 2022 and part of 2023, we have had this huge increase in commodity prices. Now, in the EM space, there are countries that are commodity producers or countries that are commodity importers. So you're going to have some of them hit by positive terms of trade shock and some of them hit by a negative terms of trade shock. But on average, and this is what you see here with this yellow line, you don't have much of, there's no directionality here. So 2022, 21, 22 is not a year where you see big movements for the group of countries in terms of terms of trade, unlike, for instance, the euro area, where you see these very negative terms of trade with the increase in the price of gas, the price of oil in energy importing group, and the flip side on the US, where you see a big positive terms of trade that also accounts for some of the way they've been their economy has been holding up in the last 2 years. So that's sort of the shocks were maybe a little bit different this time around. And the economies in EMs were also better prepared in a sense. They had better frameworks. And so here, I'm looking at both monetary and fiscal frameworks, and we're looking at the improvements from 2007 to 2021. And in many of these countries, we have these databases of indicators of monetary frameworks, accountability, transparency, etc., or fiscal frameworks. And for most of them, we see for EM countries, they've been improving, probably giving them more resilience, more ability to handle the shocks, or to let their exchange rate fluctuate without necessarily having adverse consequences. Okay, so that's the first sort of setting the stage a little bit in terms of what we're seeing for emerging market economies. So lots of resilience. Now, I want to talk a bit about external sector volatility and potential challenges coming from that. So here, one of the things that we see is, I've told you that capital flows have still been there, but the composition of the type of capital flows has changed a bit. And we get a lot more now passive type of investments, ETF type of investment into emerging markets than actively managed funds. And one of the worry there is that we know, and this is confirmed by work we've done in the research department here, we know that the sensitivity of passive investments to global risk metrics is much higher than actively managed funds. So the responsiveness of bond funds to a VIX shock, for instance, is about 4 times as high for ETFs, passive funds, than it is for actively managed, and it's about 3 times for equity funds. So there is a potential here. I mean, of course, VIX metrics, global risk metrics, are not very elevated, but if they were to become higher, there's a potential that capital flows might turn around in a much sharper fashion. Second external, risk is, of course, rates have been tightened. Some countries have been easing, but on the whole, when you look at the change in long-term real rates, they've been increasing quite a bit from 2019 to December of last year, and especially so for emerging market economies. They were already positive for emerging market economies, but they've increased substantially. Now that's a combination. It's not so much the real policy rates that have increased that much. I mean, they've become slightly positive in many countries or above the neutral rate, so we're in contractionary territory. But there's been an increase in the term premium. There's been an increase in the real term premium in many of these countries, and that's what's behind this figure here. And so, of course, that raises the question of public debt dynamics and the sustainability of public finances. And that's something that is putting some pressure on a number of countries. That's in the context in which debt has also increased. Debt has not increased that much for emerging market economies compared to advanced, because they didn't rely as much on borrowing during the pandemic. So we had a big increase in advanced economies, but they have a much sharper increase in interest rates. So the increase in the debt service, if you want, in real terms, is comparable, even though the levels of debt are much lower. Now, one of the things we did that was in our previous round of projections. We did some scenarios where we looked at what would happen if you have, for instance, further slowdown in China's growth, maybe related to the property sector problems that they are having, or if you have a tightening of the financial conditions in emerging market economies, so the corporate spreads and the sovereign spreads tightening. And so we feed that into our models, and then we look at how it would impact advanced economies and emerging markets and the global economy in 23, 24, 25. And the point here, I mean, this has to be seen through the lens of the model. So these numbers are only as good as the assumptions that you're putting in and the assumptions of your model. But one thing that comes out consistently is emerging markets, these are the little green diamonds here, suffer much more from these shocks than advanced economies. So they appear to be more vulnerable here. Now, one of the ways that the fund in which we think about what emerging markets should try to do to protect themselves and respond to external shocks and deal with this kind of vulnerabilities is to think in an integrated way. So we have this framework which we call the integrated policy framework, which is to say, well, in the old days, we would sort of look at this through monetary and fiscal policy only, and we would sort of think about, should I tighten monetary policy? Should I consolidate my public debt, or, reduce government expenditures or increase taxes? But in fact, we have a broader set of instruments we can think about, and that includes things like capital flow management, that includes things like foreign exchange interventions. And sort of the view of the fund has evolved over time in terms of whether these instruments are appropriate and how they should be deployed. It used to be 15 years ago that the fund would tell you, no, never do these things, these are terrible ideas, just stick to your macro mandate. And the view of the fund now is more that, well, under the right circumstances, you can think about using and deploying some of these instruments. But of course, it's not it's not a free-for-all, it's not everything goes, it's not cafeteria style. You have to think about the shocks, you have to think about the characteristics of the countries, and you have to think about the initial conditions. But once you start thinking about these things, you can think about what is the appropriate sort of layering of policies that you would want to implement in response to different types of shocks. And so this is a framework that has been incredibly useful. That's a work that started back when Maury was economic counselor at the fund, and that really was carried over by Gita when she was there. And that there are a number of academic papers that have been prepared by the research department and the money and capital market department at the fund that outline sort of the underpinnings, the theoretical and empirical underpinnings for this. And one of the messages that comes out from this is that if you have no substantial financial frictions, then you're kind of in the Mundell-Fleming world. And in the Mundell-Fleming world, exchange rate flexibility is going to have a lot of desirable properties, so you're going to want to let your exchange rate float, and then you're going to want to set your monetary and fiscal dials to deal with whatever inflation and stimulus that you want to have, but you will not want to use any of these other kind of instruments. Now, once you move away from a world without substantial financial frictions, then you have to ask yourself, what kind of frictions do I have, and then what kind of instruments do I want to activate? And each of these instruments comes with, it's a little bit like, taking a course of antibiotics. It's like it's good, but it has side effects as well, so you want to be careful about using them. And we have identified 3 use cases that are relevant from a theoretical perspective, where you may want to use these instruments. So one is when what is called countries that have shallow FX markets. And shallow FX markets, what we mean by this is these are the countries where you could get the type of risk premium shocks that we have in many of the models that are being done in the literature right now, whether we're thinking about some of the papers we even saw today or that we will see later on. So you can have shocks that reflect change in risk appetite of foreign investors, or the ability of the market to handle a large volume of sell order, for instance, and then without moving the exchange rate too much. So the depth and liquidity of the market is going to matter as well. And so if you're an emerging market, if you're any country with shallow FX markets, then There are things you could try to do ex ante, for instance, to deepen your FX market, develop local currency bond market, but then also exposed, if you're faced with some of these shocks, then you might want to have some forms of capital flow management to prevent, maybe lean a little bit against the wind, prevent the buildup of positions that could be unwound very quickly, or even use FX interventions. The second category where these instruments are useful is when there could be financial stability risks that result, domestic financial stability risks that result from foreign currency mismatch. So for instance, if you have a banking sector that has a lot of, or a financial sector that has a lot of foreign currency liabilities, so that having an exchange rate that would be floating might trigger valuation losses on the balance sheet of the financial institutions that can then transform what is an external shock into a financial stability risk for the domestic economy. So here again, there are some ex ante measures that would be useful. So countries may want to contain the buildup of currency mismatches by using this MPM and CFM. These are macroprudential policies or capital flow management measures. And then exposed, they may also want to deploy them or again, use FX intervention. A third category where we identify that there is a clear use for this type of instruments is when there is a chance that, you know, if you let your currency depreciate a lot, that might, through the price of imported goods, that would surge, that might lead to uncontrolled inflation processes and de-anchoring your inflation expectations that cannot be handled directly through monetary policy response. And so if that's a situation where you have, in a sense, a very fragile monetary policy framework and your expectations are not really well anchored, then rapid movements in your exchange rate could also put you on a path where you have very unstable price dynamics. And here again, that could be a situation where you might have achieve a better outcome by preventing that depreciation from happening in the first place. So all of these, you can see how each are tied to a certain type of friction or to a certain type of institutional failure. And we've done already a number of pilot exercises with a number of emerging market economies, many of them in East Asia, Malaysia, Thailand. We have a couple in Latin America, Peru and Uruguay, and I think South Africa is also one of them, where we try to identify, you know, which of these frictions might be relevant, what kind of vulnerabilities they had, and how they're using already some of these capital flow management or FX interventions. And there are some cases that come out of this where clearly the traditional policy mix is still the best option. So for instance, maybe because the frictions are not strong enough, you have a deep FX market, so that actually was the conclusion for South Africa and also for Colombia, or maybe if there is a very, very high cost of FX intervention, as we found for Uruguay. So the advice that comes from this is extremely granular. But of course, this is an area where a lot more research needs to be done, and the framework we have is sort of like a first pass, and more layers that can come from this. So of course, you know, input from academic community is going to be very, very important. As a piece of evidence here that sort of supports some of the recommendations that are made under the IPF, I'm showing you a graph that plots UIP deviations in basis points, and here positive means that your local interest rate is higher than the swapped dollar interest rate. So you're facing high interest rates at home, so you might think of this as a situation where you do have one of these risk premium shock that increasing your funding cost, if you want. And then the FXI intervention that when it's negative means that you're selling dollars. And so what this is illustrating, you can see that there's somewhat of a negative slope here. It's a big cloud, so I'm not going to oversell this. But that suggests that a number of countries are actually following kind of a lean against the wind type of policies where they're doing dollar sales at times when the dollar funding becomes more expensive, and they're sort of trying to limit to some extent the extent to which these UIP deviations emerge. And that actually gives me a transition into something I want to present, which is based on more analytical work that I've been doing at the fund together with my DAO, where we're looking not at UIP, but we're looking at CIP. And that's in some ways is very related to the paper that was presented earlier this morning. We're asking the following thing. We're looking at CIP deviations, and we're thinking of this as, you know, CIP deviation is a strange object, right? Here's a riskless trade that somehow doesn't have the same price. It's a violation from the law of one price. So clearly, something must stand in the way. Now, we could go Refet's way, and we could say, why do we have a deviation from CIP? Well, because someone must love that stuff more than someone else. But that actually may not take us very, very far. So actually, a lot of the recent work that has been done has been emphasizing that somehow when you have CIP deviation, it must be somehow that there is a friction or there is a cost that is hidden in closing that gap. And the CIP deviation is almost like the shadow cost of closing that arbitrage. And so that's kind of almost like a clean measure of the cost of expansion of the balance sheet of the financial intermediaries that would be doing that arbitrage in the first place. And that CIP, so is interesting because that's going to emerge because there is going to be these frictions. And there's some assumptions. It can even be like a summary statistic for the kind of frictions that a country that is trying to access foreign borrowing is facing. And managing the size of that friction or the size of the CIP deviation can become an intermediate objective to try to get closer to a second best policy. And we approach this question by thinking about an intermediary that is offering these forward trades, if you want. The CIPs, you're trading the local currency, the foreign currency, and you're covering the exchange risk with a forward contract. So we are approaching this by thinking directly about the intermediary that is offering this dollar forward, okay? And we have a very simple, I'm not going to get into the details of the model, but we have a very simple expression here for what is the size of the CIP deviation. So this thing on the left here, RT star is your gross US interest rate, RT is the gross local currency interest rate, and FT over E, this curly E, this is your forward premium. This is the ratio of the forward price to the spot price, so this is the forward premium. Then you take -1, and that's exactly a measure of your CIP deviation. And on the right-hand side is what the model tells us this should be attached to. And so there are a bunch of things here that are kind of interesting. One is this mu t here. Mu t is just this, you have to have some sort of friction that prevents the financial intermediary from arbitraging this thing away. And so whatever is the friction you put in there, mu t is going to be sort of the shadow cost of that constraint binding. That constraint needs to bind, otherwise you wouldn't have any CIP deviation. So you can think of this as the cost of expanding the balance sheet of the financial intermediary. Then there is something that is related to the size of the position that intermediary is expected to take. That's the second term, this FT star. This is how much of these dollar forwards you sell to the market. And so the bigger it is, then the more it's going to strain your regulatory constraint, if you want, and the more it's going to be costly for you to offer this. And then the sign, meaning whether you sell dollars forward or whether you buy dollars forward, that's going to determine the sign of the CIP deviation. And that part here is already pretty interesting because you can think of this as a hedging demand theory for CIP deviations. What it says is that if the intermediary is selling dollars forward, well, that means the market is buying dollars forward, right? The market is on the other side of that transaction. And so that's a situation where, for instance, you have a country that has dollar liabilities and wants to cover that. So I'm an emerging market economy, I've borrowed in dollars, I need to repay dollars tomorrow, I want to cover my FX risk, I don't know what the dollar exchange rate is going to be, I'm going to buy dollars forward. So that's a case where FT would be positive. Or you could have you could have foreign investors that have local currency assets, and they're also in a position where they want to guarantee their dollar return. And so that's going to generate demand for dollars forward. And in that case, then what this says, FT star is positive, it says that the CIP should be positive. And why should it be positive? Well, because you need to offer an extra return to this intermediary that is taking this position. Now, when F is negative, so that's a case where you have a country that is long US dollars, so think of Japan, a lot of dollar assets, and Japan probably cares about its yen, the yen value of these dollar assets, so it wants to sell those dollars forward. And in that case, FT star would be negative. Then the CIP would be, deviation would be negative. So it's telling you something about what you should see in the cross-section of countries, depending on whether countries are long or short in dollars. And it also tells you how it should fluctuate as the demand for these forwards is fluctuating. Now, when you look at advanced economies, that works very, very well. So if I put a measure of the dollar gap here, which means it's a net external dollar debt asset position of the country, and I put the size of the CIP basis on the vertical axis, I get a nice downward sloping relationship. Okay, so those countries that are dollar long, they're going to get negative CIP, just as I told you, and those countries that are dollar short, they're going to get positive CIP basis. And that works whether you use a LIBOR or you use government bond basis, it works very well. You look at emerging market economies, not so much. Okay, so again, the measure of dollar gap here, a measure of the LIBOR basis or the government bond basis, it doesn't work very, very well. Now, one reason we argue in our paper is because the CIP basis for emerging market economies is not a risk-free trade. I told you it's a risk-free arbitrage, but for EMs, it's not a risk-free arbitrage. Well, because you have credit risk. If you're borrowing, if you're investing in a Mexican bond or in a Turkish bond, there is some credit risk. It may not be huge, but it's there. And therefore, that needs to be cleaned. That needs to be corrected for. Now, the paper earlier today was correcting it using swaps, the CDS swaps. We're going to do it differently. We're going to correct it by using the bonds that are issued by supranationals. It turns out there are a bunch of international institutions, European investment banks or the World Bank, etc. There are a number of them. They're issuing in different currencies. They're issuing in dollars and they're issuing in Mexican pesos. They're issuing in dollars. They're issuing in South African rand, etc. And so we can construct a CIP measure using the yields on the bonds issued by this same institution. And we are not going to have any credit risk because whatever credit risk is going to be the same on the dollar or the euro leg and on the local currency leg. I'm skipping a few steps in telling you this because in fact a big part of the paper is about how we do this cleanly and it takes a little bit of work. But what I'm showing you here is, for instance, for South Africa, we can go back to 2000. And if you look at the government bond basis or the LIBOR basis, the naive ones, they are, they tend to be quite positive. They tend to suggest that somehow, if you think about the expression I showed you earlier, that somehow South Africa would have a lot of dollar liabilities that it needs to cover. But in fact, when we construct it using the supranationals, and this is this thing here, you see a very different picture. You see something that tends to be much smaller. You have much smaller deviations, except around the global financial crisis here, but otherwise much smaller CIP deviations. Much smoother CIP deviations. We do it for Brazil, we do it for Turkey, we have a bunch, we find the same kind of pattern. And then when we do our exercise again, so here on the left is a naive CIP that has the credit risk, here on the right is the one that is purged from the credit risk, where we again map it against the dollar gap, then it lines up very, very well. So in other words, those countries that have are long dollars tend to have negative CIP. Those countries that are short dollars tend to have positive CIPs. So exactly as it's a very simple theory would suggest. So that's in the cross-section. Now you can look also in the time series, and in the time series you will find, very much as the theory suggests, that when there are times when the risk appetite, this mu-t variable, I told you this is the balance sheet constraint on the intermediary, that's going to reflect any kind of risk appetite notion here, if the intermediary wants to do that trade or not do that trade. And so we are proxying this with this global dollar factor, and then interacted with the dollar gap. And what we find is that it predicts the way this CIP deviation is moving pretty well. And it works very well with the supra CIP. It doesn't work with LIBOR CIP. When we do the same thing and we look at the effect of financial regulation, for instance, so we can think about the effect of financial regulation having some effect on the cost of expanding the balance sheet of the financial intermediaries. So that becomes a triple difference. It's the VIX shock, how much dollar short or long you have in this panel regression, and then this policy measure that makes it more difficult for the intermediaries to offer these forwards. then the interesting result here is what matters is the policy regulations in the US, not the policy regulations in the destination country. And it makes a lot of sense because these intermediaries are global intermediaries. Here we're talking about global banks that are in these markets. And finally, when we look at the effect of FX interventions, I showed you earlier the graph where you had FX interventions versus UIP, but that was just a scatter plot. Here I can show you what happens if you have FX interventions. The theory says if you have FX interventions and you're subtracting a part of the demand that would otherwise have to be intermediated by the market, especially if you have interventions by the central bank on the forward market. If directly the bank is, the central bank is providing forwards to the market or intervening on the forward market, then it's subtracting some of the net demand, and that's going to directly reduce the size of the compensation that is being demanded by intermediaries. And we find, we have another paper with two other co-authors, Rimano and Iago, and we find that actually for Brazil, where we have the daily interventions, it works also very well, and it works through these forward interventions more so than the direct spot interventions. Okay, so all of this to say that when we enter that space of how we can deploy different instruments, there is still a lot that needs to be learned in terms of how they operate, how they affect the economy, and how one wants to deploy them. And so I think this is, as I said, this is only the beginning of a very exciting research agenda in my view. Now I'm going to talk briefly about the other two key challenges. One is financial stability and the other is geoeconomic fragmentation. So on financial fragility, here the interesting thing is back in March of last year, when we had the SVB episode in the US and then Credit Suisse in Switzerland, there was a lot of discussion about what should monetary policy do. And of course, the immediate response is, well, wait a minute, this is not a monetary policy event, it's a financial stability, so you want to deal with it with your financial stability instruments, and you don't want to deviate and think about how you would want to adjust monetary policy. But at the same time, in the background, there was very much a sense that a lot of these financial fragilities, especially in the case of SVBs and the mid-sized regional banks in the US, a lot of the vulnerabilities had been coming because of the tightening of the policy rate. That meant that all of the assets on the balance sheet of these medium-sized regional banks were, worth a lot less mark to market because of the increase in interest rates. And so there was clearly a link in raising interest rates and the financial fragility. And so the question was, well, does that mean that somehow monetary policy should pause or should go more carefully because there could be financial stability risk? The general response, as I alluded to earlier, is kind of, you can think of this as a separation principle. There is monetary policy on one side, there is financial policy on the other side, and you want to keep them separate. And what I want to argue is that, yes, that works kind of most of the time, but it doesn't work all the time. And it might be particularly tricky for emerging market economies to be in that separation principle space, and for them, the trade-offs might be much more difficult to handle. And so here, I'm putting on, this is like a 2x3 matrix here. I'm on the rows, I'm putting whether your inflation is below target or inflation is above target, meaning that in the first case monetary policy might want to ease, and the second case monetary policy might want to tighten just on the grounds of its monetary policy mandate. And on the columns I'm putting different levels of financial stress, and the way we've been thinking about it at the fund is to think about these different buckets of financial stress. So first bucket on the left is no stress, or individual stress. An individual institution can have some difficulties, but it's really not systemic. Then some sort of, acute stress on the right, which is, you have a systemic crisis, financial crisis, and then there is some bucket in the middle, which is not quite no stress and not quite a crisis, and that's where a lot of the interesting things are going to be happening. And so, if your inflation is below target, I mean, you might say, okay, well, if I loosen monetary policy, if I have no stress, or even if I have rising stress, cutting interest rate is not going to directly hurt my financial sector, so it looks like there is no trade-off. Although that's not quite the case. In fact, there is a trade-off, but it's more of an intertemporal trade-off. The intertemporal trade-off you face is because interest rates are going to be low, you might have the financial sector taking on more risk. You may have, search for yield. You may have a buildup of vulnerabilities that then later on might come back and haunt you. But initially, at least, it's not clear that you have a trade-off. If you were in an acute stress situation where you have a financial crisis and you have inflation below target, then also you don't have a trade-off, because at that point, cutting interest rate is good for aggregate demand and it's good for your financial sector. So there's no tension there. So in a sense here, you want to be a little bit careful maybe in terms of the intertemporal trade-off you provide, but there's really not much of an issue here, and separation is going to be enforced pretty easily. Now the question, if inflation is above target, here it's easy. If you have no stress, then fine, you can tighten monetary policy. If you have acute stress, then again, if you're an advanced economy, then things are aligned again. If you have a financial crisis, aggregate demand is going to collapse. You're not going to be in a situation where inflation is going to be your concern. Your concern is going to be your economy is going to tank, and you have a financial crisis. So you want to cut interest rates, and so there is no trade-off again. But I say this is for advanced economies. It's not necessarily the case for emerging market, developing economies. And why do I say that? Well, because for emerging market and developing economies, if you loosen monetary policy, you might have severe capital outflows, you have a depreciation of your currency, and you may have totally unstable price dynamics. So here, even in a crisis, you have a situation where there is a tension for emerging market and developing economies. And now here, in the intermediate bucket, there is also a trade-off, both for advanced economies, but maybe especially so for emerging market and developing economies. Why? Well, because now here, if you tighten monetary policy, you will increase the fragilities of your financial sector. You may bring it closer to a crisis. Now again, you might say, well, we can try to deal with that with, let's say, financial policies. We can have maybe a separate vehicle that is going to provide liquidity to the financial sector, like the Bank of England did with the indexed gilts in September of last year. Or you might, like the Fed did with the bank term facility that introduced in March of 2023. But the gilt was September 2022, so it was a year and a half ago. But that means that the problems remain only liquidity problems. A central bank can deal with liquidity problems. It can offer a facility that will provide liquidity against collateral, as long as it's a liquidity problem. If it becomes something more than a liquidity problem, you need fiscal resources. And you may not have fiscal resources. You may not have them because you're constrained in terms of what you can do by the regulatory framework, or you may be constrained because you just don't have fiscal space. And so if you don't have fiscal space, then now what you're effectively saying is you're saying that separation doesn't work in practice. If I raise interest rates, I'm going to tank my financial system, and there's not going to be a backstop. And for emerging markets, it's even worse, because for emerging markets, there is again this risk that, as you get closer to having a risk of a financial crisis, there is typically less fiscal space than in advanced economies. There is less ability to tap the market when you need it. So in practice, what I want to take away from this is we shouldn't be just believing that somehow it's always possible to deal with a separation and assume that we have a separation principle and we can separate monetary policy that can stay the course from financial stability objectives. And you may have situations where you have to sort of adjust course. And the difficulty there is that once you start doing that, then you're entering the world of financial dominance. You're doing this because there are financial fragility risks. How is that ex ante not creating a problem as well? Okay, so this slide is basically just summarizing what I just described, so I'm going to skip it. And this slide is sort of, thinking about what the policy advice would be, depending, again, on the levels of financial stress and whether you want to use monetary policy or other types of policies. Again, I've covered most of that, so I'm gonna skip that. All right, so let me get to the last key challenge for emerging market economies, and that's geoeconomic fragmentation. And so here, when we talk about geoeconomic fragmentation, this is something, of course, doesn't, it's been going on for a while. You can think about the China-US trade war as a sign of geoeconomic fragmentation already. You can think of all the measures that have been taken since Russia's invasion of Ukraine. You can think about all the trade sanctions and other sanctions that have been implemented. It's very clear that the number of distorting trade and investment measures that we've seen has really exploded in the last few years. So it's upwards of 3,000 in 2022 and 2023 when it was, maybe 1,000 in 2019 and barely 500 10 years ago. So there's an explosion in number of trade-related distorting measures. And some of them are on the grounds of trying to enforce energy security. Some of them are on the grounds of strategic security. You can think about some of restrictions on trade, particular types of chips between the US and China. Some of them might be restrictions in terms of exports of certain types of foods. So India's ban on rice exports, for instance. You have all kinds of measures there, but it's clearly been exploded. When you look at earning calls and you look at the mention of geopolitical risk and fragmentation, this is also something that is top of mind for decision makers and the business. Another thing that we see is that we see a sharp recomposition in terms of overall trade flows. Now, we are not entering deglobalization. I think I want to be clear that fragmentation doesn't mean that we have deglobalization. We have no signs of that. What we have is a plateau in terms of trade to GDP or measures of globalization. But under the surface, there is a lot of recomposition. So here, what this is showing you is trade growth within blocks and between blocks, where the blocks here are, of course, we don't live in a world of blocks, but what do I mean by blocks? As a descriptive exercise, suppose we put countries in different blocks depending on how they voted at the March 2022 General Assembly of the United Nations resolution condemning Russia's invasion of Ukraine. A number of countries abstained, a number of countries voted in favor of condemning Russia. So suppose you put them in those blocks according to this, which means effectively there is sort of a China-led bloc and there is a Western countries-led bloc. And what you see there is that the trade, whether both total and strategic sectors within blocks, is not very different post-2022 than pre-2022, but the trade between blocks has collapsed. Okay, so it's declined massively. So there is recomposition in the trade flows, and that is not just the US-China. Even if you exclude US-China, this is a difference here in trade growth between blocks, excluding US and China as being a country on either side of the trade flows across the blocks. That's still a big decline. Now, what is going on, really? Well, what we have is we have a big decline in trade. For instance, between the US and China, there's been a big decline in trade, especially in the sectors that have been affected by the sanctions, whether the trade tariffs or any kind of measures that have been taken. But this has been substituted by increased trade coming from other countries, and in particular countries like Mexico or Vietnam. And in fact, I'm going to show you some numbers in a minute, in fact, a number of countries are now playing the role of connector countries. So instead of having goods that are being shipped from China to the US, you see goods that are being shipped from China to Vietnam, and then they are shipped from Vietnam to the US. And they don't fall under the sanctions by going through this extra step. Or they go from, or you can see the same thing when you look at FDI. You might have restrictions that prevent goods from being produced in a plant in China being shipped to the US. What you see instead is you're going to see Chinese investment in factories in Mexico, and Mexico is going to ship goods. This factory in Mexico is going to ship goods to the US. So we see a lot of recomposition of trade rather than deglobalization. Now, let me not make the world economy more resilient because you're adding nodes to the supply chain, and that's something that, of course, is something that we want to be concerned about. So we looked at a particular case, which is the import of lead acid electric storage batteries. You see that very clearly. You see the decline in China's imports, China's exports to the US, and you see an increase in what comes from Mexico, what comes from Malaysia, what comes from Vietnam. You see the same thing when you look at FDI. More systematically, beyond the sort of the anecdotal examples, those countries where you have some of the biggest increase in their exports to the US are also the countries where you have the biggest increase in their imports from China. Okay, so again, this is sort of this change in Chinese export share, the change in US import share. There is a strong correlation there. Same thing when we look at FDI. Now, why should that worry us? Well, we should be worried that if we keep going down that route where we have more and more fragmentation, then this is like an increase in trade costs, and that's going to be hurting the global economy. And it's going to be hurting the global economy in different ways. Not everyone is going to be hit in the same way. Some countries might actually benefit. And so we've done a number of exercises using trade models, using macro models, where we look at the scenarios. We start from the current situation, and then we ramp up the trade costs between different trading partners, or we ramp up the investment costs when we look at investment FDI, for instance. And what we see is that you get a sort of a distribution of losses. Again, this is very modeled. This is our model exercise. Depends on how you model the fragmentation, what kind of cost, in what sectors, whether you associate with that a slowdown in the technology transfer, for instance. That has a big impact on the results. Is you might imagine that if you have less trade flows, you also have less technology catch-up for countries that are away from the frontier, and we get a distribution of trade costs, of output losses. That the point here is that the median may be relatively small, but there are relatively fat negative tails. So some countries stand to lose quite a lot, especially among EMs and low-income countries. This is where we see most of the losses being concentrated. We did an exercise looking at FDI fragmentation between a US bloc, a China bloc, and then non-aligned countries. And non-aligned, to some extent, you could imagine that they stand to benefit because now they can trade with both sides and they can trade more. But there is one effect that sort of overwhelms this, which is that in a world where you have this fragmentation, you probably also have more policy uncertainty in terms of whether you're going to still be able to trade on both sides. And so once you add this layer of policy uncertainty, then that depresses investment and generates losses around. Okay, so conclusion, I'm almost out of time. So emerging markets have so far weathered global shocks well and are displaying remarkable resilience. Now we see challenges in terms of managing external pressures, and I've talked about the tools that we have, the integrated policy framework, and how we are thinking about how it should be implemented. There are concerns about financial stability while ensuring price stability for emerging market in particular, where trade-offs may appear and countries may not be able to maintain the separation principle. And that's particularly relevant because once you start having build-up in financial fragilities, you have also potentially non-linearities and big amplification loops that kick in. And then we see the risk of geoeconomic fragmentation as something that could weigh down, especially so on emerging market economies. Now, this kind of tongue-in-cheek, what's the first best? Well, avoid fragmentation, of course, if we, that would be best. But then another aspect here, which we think is important, is to make sure that countries that are implementing restrictions evaluate the costs and benefits and the spillover effects of these measures on other countries. Something that we're very concerned about. Let me stop here.
Excellent. We have time for some Q&A. Let me kick it off. So in the integrated policy framework, there is one reading of that is looking at what a whole bunch of countries have been doing and ex post rationalizing it in a meaningful framework, and nothing wrong with that. But that kind of assumes that what these countries were doing was good policy in some sense, which is probably correct, but maybe not by the right policymakers. That around the world, central banks began to do too much policy work. And now that central bankers running around for all kinds of policies not done by anybody else in the country has a stamp of IMF approval. Is this something that we should be worrying about in terms of its economic and political economy implications?
Yeah, so there is. Let me take first issue with the first part of your question. Do we just put a stamp of approval on what countries have been doing because that way everyone will be happy? Not quite. And I think what was interesting with the IPF discussions is countries were coming at this from very, very different angles. You had countries, many countries in Latin America, for instance, who did not want to open the Pandora's box of FX interventions, capital flow management, because they were very concerned that even though they themselves may not want to do the wrong things, that maybe some future administration may decide that this is something they could exploit in various ways, and so they were very concerned about the sort of the policy slippage that this would allow. And there is a serious concern that you don't want any of these FX interventions and to be things that are done instead of the underlying core macro stabilization that you should do. You don't want to do FX intervention because you don't want to raise your interest rate because politically it would be costly to do so if that's the right policy to do, or you don't want to let your exchange rate depreciate, though that would be the right thing to do. So there was one group of countries that was very, very reticent to this. And you had another group of countries, and many Asian economies maybe were more in that camp, that had been using this type of instruments and would have been, in the IMF of the old days, would have been constantly telling them, you shouldn't do this, you shouldn't do this, you shouldn't do this. And they would keep telling us, yes, but it works for us, it works for us, it works for us. And so with them, discussion was more of the side of, let's try to understand what works and let's try to understand what doesn't. And I think we've made progress with both groups of countries. We can understand that having a framework and having, it's not a free-for-all, it's not a cafeteria, is useful in shaping when things are appropriate and not appropriate. Now, does it mean that there is, in the sense that you have an overburdened central bank that now has to do all these things? I mean, I think when it comes to FX interventions or when it comes to capital flow management, I mean, this is completely in the remit of central banks. We're not talking about fiscal policy here. We're not talking about measures that should not be there. So I'm not particularly concerned about that too much. And as I said, a number of countries are already doing it. So it's not that we are telling them that there is these new instruments that they never touched. So this is necessarily one of the first that we would have. I think this is something where implementation, we will have to see how it's done over time. And I think we'll have to learn also how to do it well. What I would love to have, and we don't have right now, is to be in a position where even though it's, you can think of a Taylor rule as being something that is wrong. It's never exactly right. You could say, I have a Taylor rule, we have Taylor rules in our models, but at least it's useful thinking about what monetary policy should do in responding to inflation or output gap. And I don't think we have the equivalent rule for, let's say, FX intervention. So when you're in a space where you could use it, conceivably it's the right instrument, how should you deploy it? And in a sense, what the work that I have outlined today is, well, maybe we should think of it as how much should you lean against the wind? How much should you try to close a CIP deviation or a UIP deviation? But we don't have these rules. We don't know what would be the right thing. And I think that's where we have to make a lot of progress.
Thank you for the presentation. Just a quick follow-up on your Taylor rule point. Because we seem to be going towards a world in which we're going to have more frequent and more volatile supply shocks. And my question is whether we should not do more work to try and understand whether there's a better rule than the Taylor rule, in which maybe we don't always respond to increasing inflation, but we rather calibrate the response to the type of shock, because otherwise we might observe a lot of volatility in interest rates, and that might be problematic in itself. And the second quick question, if I may, is on the we have these two instruments, right? Intervening on the policy rule, intervening on the long end of the yield curve. And the question is whether we need to think of them as imperfect substitute that we can calibrate when, for example, there is spillover at the long end of the yield curve, or there is an over-tightening at the long end of the yield curve.
Yes, these are two big questions. I think the consensus has moved on both of these questions. On the question of should monetary policy, even if we identify something as a supply shock, just sit tight and do nothing, because after all, in some of the models we have, there's nothing that it can really do, so why don't we just wait? And by the way, I would not disagree with the fact that, a lot of the inflation dynamics has the hallmark of a supply shock unwinding, and so that to a large extent was beyond what central banks would be doing. I don't think that that's a position that can be defended anymore. I think central banks in advanced economies in particular took a lot of pressure when they were not responding. I think you could argue that it stabilizes nominal rate, but it certainly doesn't stabilize your real rate. And the risk there, which is the one we don't have in many of our models, because if you think about the way we write our models, most of our models assume that whatever we do, we're going to maintain the credibility of the rule, and we're not going to get in the state of the world where things are exploding, etc. So inflation expectations are not an object. They're actually totally a function of the underlying shocks. This is not a separate variable in these things, and they are going to be converging. But that's not what happens. What happens in practice is that at some point you start losing credibility, you start losing the trust of the households and firms, and then your inflation expectations start drifting. You don't have a choice. You have to raise rates, if only to convince the market that you're not going to let this thing drift away. So I think that there's been a little bit of a change in the thinking about this. That's point number one. Point number two on the you don't want to target the short rate or longer rates. Let me put it slightly differently. Some countries have tried to do that. Australia, Japan have tried to control both. So the short term and the long end. It's pretty difficult, and you can see. I mean, Australia exited YCC, the yield curve control. That was pretty bumpy. That was pretty messy. Japan has not exited. It's moving in the direction of exiting. It's introducing flexibility, but it has not exited yet. And there are still questions about, doing that. So in the context where you start the need to raise rates, it's very difficult to think that you can do it by trying to keep, deciding what the slope of the yield curve should be and then targeting that. Now, the other way you could try to do this is through forward guidance. And so you don't have an explicit target for your 10-year, but you announce what the short rate is going to be for a while. And here again, this is, I think, where there's been a rethink of the way central banks are operating. I think there is, at this juncture, a lot less weight on forward guidance because it's been tying the hands of the central banks. And when there are these shocks that you talk about, these large shocks that are coming in that mean that you need to come and explain that we are now in this new world and the promises you made yesterday, they don't hold up anymore. There again, you get a problem in terms of communication, in terms of next time you try to convince the market you want to do something. So I think the whole issue of forward guidance, there is a lot less appetite for it. That's what I see from the central banks now than maybe there was at the time of the ZLB, when you really had no short rate policy instrument, and so you were trying to find other ways in which you could influence market and long-term rates. Now, that could come back, maybe if we're back in the ZLB in 2 years, but right now I think there is very little appetite for that.
Thank you, Pierre-Olivier, for the nice presentation. I have a question on the fragmentation bits of your talk. And in particular, I was really struck by the chart you've shown with trade within and between blocks, which I found very, very stark. And it led me to think about whether some of the dynamics that you documented could lead to a change in the role of the dollar as a dominant currency in the world economy, both in finance and in trade. And basically, is this a risk that you could consider a plausible or a non-negligible risk? And if so, what could be the consequences? I just want to get, if you could share your thoughts on these aspects. Thanks.
On the facts, we have seen very little change in the, very little meaningful change in the currency of invoicing or currency of financial transactions. There is a little bit of movement in some satellite currencies, and I say satellite currencies because they are attached to the G7, and so whether it's the Australian dollar or Canadian dollar, but very little in terms of really rising to a point that it would be macroeconomically relevant in alternative currencies. So I don't think that's, and the same is true for reserves, where in fact, if you look at so this plot I had about the connector countries and that we have in trade, we have something similar when we look at financial flows, which is that now some of the reserve holdings are done at arm's length through special vehicles, through custodian banks that are located in third countries with different maybe potentially different legislation. And so there is a way in which it's more hidden. At the end of the day, you might still be holding US treasuries, but it's a bit at a remove, so it's harder to trace. So I don't think there is any major threat right now. But I do think that part of what we're seeing is also sort of ripple effects of the rise of emerging markets, in particular China, and how we have a recomposition of that's going to be both in trade, it's going to be in financial flows, it's going to be in international governance that will happen. And this is sort of a slow-moving process, but we're seeing a little bit of tremors and along the way. So no immediate threat, but something that I think we need to be ahead of if we want to make sure that this is a transition that happens smoothly.
Very good. We'll take one last question. To you, yes.
Thanks for a very interesting presentation. You showed in one of the earlier slides that if you look at FX bases versus the country's exposure or the country's net dollar position, when you looked at emerging markets, you didn't really see the expected relationship until you took the credit into consideration. So if you're thinking of this as a basis for countries to intervene in FX markets, how do you take into consideration the fact that often you have this pro-cyclicality where you have a deterioration in credit quality at the very time that the basis opens up? So if you're an EM, you're trying to intervene, I would think that you would be trying to correct for the impact that is just your net dollar position, but not necessarily your credit quality issue that maybe has also led to markets becoming less liquid. How would you as a policymaker then thinking about what you're correcting for be able to separate those two things? Or is that not an argument actually for not doing anything?
I don't think it's an argument for doing anything. I mean, one of the points of doing this was precisely to say that you can measure the true balance sheet cost of intermediaries in providing dollars to your country if you're a dollar short country, or absorbing dollars if you're a dollar long country. And that relationship is, you can think of this almost like the demand curve on the part of the intermediaries that are absorbing the dollar position. And it's important to get it clean from credit risk, because this is, in a sense, this is measuring the friction on the external market. The credit risk is a separate thing. And of course, you want to reduce your credit risk, but that's something that has to do with your fiscal policy. It's not something that your FX interventions or your monetary policy will necessarily help you very much with. And so the reason that you care about this thing here is we know that when you have, think about a risk-off shock, when all of a sudden the global markets seize up, then you're going to have this CIP basis is going to become very expensive for you. It's going to become very, very difficult for you to obtain these dollar forwards. And so you may want to intervene from an ex-ante perspective. You may want to intervene so that you limit the extent to which you let this basis be too wide in the first place, and maybe with regulation or with FX interventions, and so that when a shock happens, you start from a better position. Yes, you're going to have an increase in your basis, but remember the overall cost is the marginal cost of each dollar unit times how many dollars you buy. So if you start from a position where you don't need as many dollars, then you're going to be able to absorb that extra cost, and it's going to be not as expensive for the country. So that's the sense in which this is the right thing that you want to measure. Now, everything that you said about the credit risk as being relevant and also potentially spiking at times like this, well, this is compounded. In a sense, if you can access the dollars that you need to access to in times of crisis, then you may have less of an increase in the risk premium on the government debt. So I'm not saying that necessarily has to go that way, but potentially. So I would separate the two issues, and I think you want to have clear measurements so that you can address the problem with the instruments you have that are designed to tackle that. FX interventions or capital flow management are not going to be helping with the solvency of the public sector.
Very good. Excellent session. Thank you very much once again. We're off for lunch, and we'll be back for the next session at 2 o'clock. Thank you again.